In this video, I'll be teaching you guys how you can get higher RR trades and predict high of the day using the ICT power of 3 concept in a market maker buy or sell model. Here's everything you can expect in this video. We need to dive into what a market maker X model, which the X just stands for buy or sell model, is. And I have a full video explanation on that. I posted about 12 days ago. I will leave that in the description down below. I'll go over a simple explanation for those that don't feel like watching that entire 30-minute video. This is what a market maker sell model looks like. Price moves from a buy side of the curve where it's offering higher prices, reaches a level where you anticipate a reversal at, and then it turns into the sell side of the curve. So on the buy side of the curve, as price is retracing higher, it's leaving behind these old highs or old lows. So we have all of these old lows getting clustered close together. Retail traders that are going long, they're going to put their stop losses beneath these lows, which is a sell order when you are long. Once price reverses and smart money, the ones in the know, they short up here, and then as price is distributing to the downside on the sell side of the curve, it's targeting all of these old lows because now it's going to target those sell orders beneath these lows so smart money can buy back their short position from the sellers. So now let's dive into a 4-hour market maker sell model on the NASDAQ. You can see that this is the exact representation that we have going on here. Price moves from the buy side of the curve, leaving behind old lows, reaches a PD array where you anticipate a reversal to happen at. We look for SMT divergence up here. Smart money reversal occurs, then it starts targeting all of the old lows. It's exactly what we have going on in the NASDAQ here. So it leaves behind these old lows, and then it reaches the smart money reversal level. There is SMT divergence here. So NASDAQ, you can check this out on your own chart, it makes a higher high. So see how NASDAQ takes out this high right here? The S&P 500 doesn't take out that high. So that's SMT divergence, and that's bearish. Once that happens and it starts to distribute lower, once I see that, I know, okay, price is going to start targeting all of these old lows. Now in this video, we're going to be discussing how to get entries in on this market maker sell model in here and predict high of the day and also get high RR trades. Before we do that, a lot of people are saying in their heads right now, this guy's just in hindsight, just like every other ICT student. Well, if you check my Twitter out, this was on October 13th. I'll show you the date right here, October 13th at 3:08 p.m. I said how I see it unfolding the next week or so, tagged ICT in it. Smart money reversal, low risk sell. I was pointing the arrow down because I want to see price start targeting the sell side liquidity. This was the minimum target, and this was the original consolidation target. So this was how I saw it unfolding over the next week. And if we take a look at the NASDAQ chart from that date over the next week, it did target all of the sell side liquidity below. So I'm not just showing you guys that this stuff works in hindsight. I will leave that tweet down below because this stuff does absolutely work in real time every single day in the market. So as price is on the sell side of the curve, how can we get entries? Let's dive into it. This is not something that you are going to see every single day using the power of 3. Now you can capture market maker models every single day in these markets. Not saying you should. I think if you're a beginner student, you should just try for one time a week finding a good model. But in here are examples of when not to trade it. So when it's low probability. So the first thing that we want to do is mark out midnight and 8:30 open. This is how we're going to use the power of 3 concept, whether it be the S&P 500 or the NASDAQ. We want to mark out when we are in a market maker sell model, right? You doesn't have to be in a market maker sell model, but in this example it is, and we're anticipating lower prices. So since we're anticipating lower prices, that's when we want to apply the power of 3 concept, when you already have a draw on liquidity. So I want to mark out the opening price of the midnight candle, New York time. So go to the bottom right hand corner. Doesn't matter which time zone you're in. You want to click it on New York if you're trading ICT concepts, and you want to mark out the 12 a.m. candle on there, the opening price of that. Then I also want to mark out the 8:30 opening price. Since we're expecting lower prices, we want to see price manipulate above both of these and then create a bearish model. See how we don't have it on this day? See how it just manipulates higher, and then this is 4 p.m. all the way up here? That's fine. That means you missed that trading day. It doesn't mean that you missed the opportunity here because it didn't give opportunity for a short setup. What you're looking for is you're looking for manipulation above midnight and 8:30, and then you're looking for a sell model, something like this. You want to see buy side liquidity get taken out. You also want to see a fair value gap get created and a market structure shift to the downside. So that would be the market structure shift right on that blue level right there. If we don't have that, there is no power of 3 set. So in this model, what I want to look for is I want to see manipulation above midnight and 8:30 open, and then I want to see this bearish 2022 model after it manipulates above that. So in this example right here, you can see that price takes out this buy side liquidity, but we don't get a bearish model above there. If I were to see something like this above this high right here, then I would take that and I would look at that as a short opportunity for price to start displacing lower. See how it doesn't do that and it just pops right above it and actually displaces higher and we never get a bearish model? This is an example of a low probability condition because price took out buy side here, but it displaced above it and we never got a bearish model in here. It just chopped around and then at the end of the day closed around here. So this is just an example of when you wouldn't trade. There's going to be days where it doesn't present itself, but until it reaches that sell side, every day you can go into the market looking for that. So same idea over here. You can see that it doesn't look like we get an opportunity, but then it does towards the end of the day. So we want to mark out midnight and 8:30. So this was Monday's midnight. Now we're going to mark out Tuesday's midnight. So I'm going to zoom in on this candle for those a little bit confused. See, if you look at the bottom part of the screen right here, it says 12 a.m. I'm just marking out the open of 12 a.m. and then I'm marking out the open of 8:30 a.m. Since we do have a bearish bias, we want to see price pop above 8:30 and midnight or midnight. So in this example, see how 8:30 is lower than midnight? Well, then we could just use 8:30 for price to pop above. So all it needs to go is a little bit above there and then create a bearish model. So whenever you're looking at midnight and 8:30 and you're looking at a bearish scenario, you could just wait for price to pop above the lower one. And then you look for a entry model. I look for a 2022 entry model in close proximity. So it doesn't mean that you have to short above 8:30 open. It just means that it has to pop above it and then be in close proximity to it when it creates the 2022 model. So you see in here, as price reaches the 9:30 opening, it just starts to displace much higher. We're not looking for shorts down here. Why are we not looking for shorts? This is at a deep discount. It's below sell side liquidity, right? We want to see price above 8:30 or midnight. So in this example, 8:30 is lower. We want to wait for price to pop above that. So when we go down into the lower time frames in here, you can see that price starts popping above that 8:30 and midnight open towards the end of the day. You can see that pops above 8:30 right in here. Why would we not take a short right away, Dan? Because we're waiting for the 2022 model above or in close proximity to the 8:30 or midnight open. So it pops above both of them. What does that show? That shows that the market is in a deep premium. What does a deep premium mean? It means that if smart money is going to start displacing price lower, this is really going to be an area now where they're going to start looking to short the market. Once price pops above midnight and 8:30, that's a deep premium. Once it pops above 8:30, that starts becoming a premium. Now, when it creates this 2022 model in here, see how it creates the market structure shift? Then we have a small little fair value gap in here. Now this becomes high of the day and price is going to start working towards the sell side. So how can we get higher RR trades here? Well, we can hold in the direction of that 4-hour market maker sell model. So it's supposed to head all the way down to here based on that 4-hour market maker sell model. We can get in short at this high. Where's our stop loss going to be? It's going to be above the high of the 2022 model. We're going to anticipate for this to be high of the day now because it's done the manipulation above 8:30 and midnight. How can we get higher RR, Dan? We can draw a standard deviation from the swing high up here to the recent swing low. And we're going to bring up some standard deviation targets. You could hold for a -2 standard deviation. You could hold for a -2.5 standard deviation. If you wanted to do a low-hanging fruit, you could hold for the -1 to 1.5. Typically what will happen is you'll get a retrace in here, and then it'll expand for the -2 to 2.5. Other targets you could look for is you could look for sell side liquidity over here. You can see towards the end of the day, if we do let this play out a little bit, it did end up taking out this level of sell side. Or what we could do is draw a fib from this swing low to this swing high. So something like this, drawing a fib from here to here, and then we can mark out the premium and discount. So you could look for a fair value gap in a discount of the range, which would be down here, which it doesn't end up hitting. So there's a numerous amount of ways that I could look for targets in here. I will make a separate video on that at some point. So if you guys would like to see a video on coming up with targets for these 2022 models, leave a like down below. If this gets to 100 likes, I will make a video on that. But yeah, you can see that pretty much we manipulate above the midnight open. We get the 2022 model. And once we get that, you don't have to short above the midnight, but it needs to be in close proximity to that. So in this example, it was above there, and then that puts in high of the day. So before we do continue, if you guys are interested in joining my Discord, I do have a 3-day free trial. I will leave the first link down below. I do cover more educational content in there. And also I do call the market real time on ES and NQ. I don't do live streams, maybe here and there I will, but every single day I'm going in, seeing if there are setups in there. Here was this morning on the NASDAQ chart. I was looking for sell side to get hit. Said the lows are too clean in my opinion. That's my draw on liquidity. You can see later it does end up taking out the sell side. Same applied to the ES chart. So I posted ES and I said this was my draw on liquidity, and I did end up taking a short trade on that. You can see in here we did present a bearish setup, and that actually ended up putting the high of the day in, and price started just expanding for the lower. So we did go over a few other nice setups. This was ES buy side of the curve in the PM session. Actually, this was later in the AM session. Only did take out those first two targets, then reversed. And then we did also get a few other nice setups later in the day. Did take a few scalps towards the end of the day. If you guys are interested in seeing that, make sure you check out that first link down below. So this was on Tuesday. If we fast forward to Wednesday over here, you can see it does take out that lower sell side liquidity. If we do the same exact thing in here, if we draw out 830 open, so on the 830 opening candle, I'm just going to extend out a horizontal ray. You go to the left-hand toolbar, click on horizontal ray, and that'll get you to this, which just kind of extends it all the way to the right. What you could also do is mark out the midnight. So the midnight opening candle, doesn't matter what time frame you're marking it out on, it just needs to be at midnight New York time and 8:30 open New York time, just the opening price for that. Could be on any time frame that you mark it out. We want to see price manipulate above there, create a bearish 2022 model to the downside. We get that right here. When price retraces into this bearish fair value gap right here, that is a short opportunity. Where's the high of the day going to be at? If you guessed up here, you are correct. Why? Because this is where it created the 2022 model. It manipulated above 8:30 at midnight. We know once it manipulates above both, it's a deep premium market. When price displaces lower, this is going to be high of the day. When it returns to the fair value gap, we can anticipate for this to act as resistance and start working towards the lower. Why, Dan? Why won't it just come back down to sell side and then create a bullish model and start expanding higher? We need to have that higher time frame narrative in play. We thought that price was going to start displacing towards the sell side. So bullish models along the way are going to be low probability until it takes out the sell side liquidity. So price manipulates above the 8:30 and midnight open. It creates the bearish 2022 model. Once it creates the bearish 2022 model, we know that this high is going to be high of the day. And we can expect this bearish fair value gap to act as resistance. And now this started the sell program to the downside. Where can we target? You could draw a standard deviation from this swing high to this swing low. You could target the -1 or -1.5. You could also target the sell side liquidity, which we have over here, or you could hold all the way for the -2 standard deviation. In this example today, it did not reach all the way down into the -2 standard deviation, but you could see the RR would have been very good if you just entered short in this bearish fair value gap, stop loss above high of the day, and then targeted that -1. That's a 1 to 2 RR trade. You're not in here to get the most perfect trades. You're in here to make money. So this is a nice low-hanging fruit target, which did give about over 200 points to the downside from high of the day down to here, but from the bearish fair value gap, gave about close to 200 points into the middle of these standard deviations. So zooming back out to the higher time frame, remember our draw on liquidity is still lower. So every single day we're going to go into the market and look for a bearish power of 3 to set up. Monday, we look for manipulation above midnight and 8:30. Opportunity did not present itself. Tuesday it did. Wednesday it did. Now let's check on Thursday. So if we go on to a 10-minute time frame in here, you can see that price kind of just consolidated around. This is a day that you do not want to trade. I believe that Powell is speaking, so I wouldn't have traded this either way. What can typically happen on these type of days is you get a bearish model, but then it kind of fails, or it just does one more run on liquidity, but you still have the same bias. In here, technically, you could look at this as a market structure shift with a fair value gap. One of the rules that I go by is if we have clean equal highs above, I will not trade that. So price pops back above it, takes out that liquidity, and then creates the bearish 2022 model. So we have the bearish 2022 model right here, returns back into this order block right here in this fair value gap. This is just a low probability day. You could see that there was ways to manage it if you did follow that rule with not trading with equal highs above. So price returns back to the upside. The bearish short opportunity would be in that fair value gap. Draw a standard deviation from the swing high to the swing low over here. and then we can look for a -1 to 1.5 or a -2 to 2.5. If we do let this play out, it did end up closing right above that -2, but this was still a potential short opportunity. So price manipulated above the midnight and 8:30 open. Once it created the bearish 2022 model, this put in high of the day, and you could enter short on that fair value gap. So going into Friday, still targeting these lows. Tuesday, Wednesday, and Thursday presented a bearish power of 3 opportunity. Monday did not. Let's go into Friday, see what this offered, which it did. It did manipulate above the midnight and 8:30 open. When it manipulates above both, that's going to be at a deep premium if the draw on liquidity is lower. So you can see that price creates a bearish market structure shift by breaking through that low. You could also look at this as the bearish market structure shift. This is now going to be high of the day in here, and price is going to start working towards that draw on liquidity target. So where can we draw the standard deviation from? This swing high to this swing low, because that's kind of the leg where price created that market structure shift off of, and we could target these standard deviation levels. So this is going to be high of the day. You could enter short in any of the fair value gaps in here and start targeting these standard deviations. It does a deep run on internal liquidity, does not take out high of the day, just misses it by like a few points, and then starts to expand for the -2 standard deviation. This is how you could utilize the power of 3 concept in a market maker sell model. So that's going to be it for this one. Before we do finish off, I want to go over institutional order flow real quick. As price is targeting the sell side liquidity, institutional order flow is where up close candles act as resistance. See how price is just returning to up close candles? This is bearish institutional order flow because it's returning to up close candles, but then it's retesting them as resistance, and then price will trade lower from them. In bearish order flow, you're looking for up close candles to act as resistance. Also in sell programs, when institutional order flow is bearish PDRAs are going to be respected, and bullish PDRAs on this side of the chart are not going to be respected. So that's going to be it for this video. Hopefully you guys enjoyed, and I will see you guys next time.